Thank you very much. What John didn't say is that Jeff and I actually shared an office, and what happened in our office will stay in that office for both of our sakes. Let me echo also, if I could, John's acknowledgement of the traditional custodians of the land on which we're meeting, and express my appreciation to Ben Wyatt, Bill Johnson and Rita Safiotti in coming along today. My subject is the challenges and opportunities for Australia presented by global developments. These developments are contributing to a series of pressures in our economy, and that if we're to respond to them effectively, they're going to require an informed and considered national debate. Not only a debate about how we respond in the short term, but a debate that really focuses on the very long term, because much of what we're seeing is a set of forces at work that are restructuring the global economy, and we're being caught in part of that. These longer-term drivers, those that are really reshaping the global economy, include the rapid pace of technological change, which has revolutionised the way in which we run our lives, just even in the last decade or so. Add to that the challenge of sustainability, whether you're talking about climate change or water, food or energy security. We're really talking about biophysical forces at work that human beings are going to have to work out how to respond to. And then the third is the impact of demography, because wherever you look around the world, in key countries, the population is ageing, and in some cases ageing very rapidly. A decade ago, when we were talking about the emergence of China, a classic question we kept asking ourselves was, would China get rich before it got old? So whether it's China, whether it's Northern Europe, whether it's Japan, whether it's Australia, you're seeing demographic change everywhere. What I want to do today is talk a little bit about one of the key long-term shifts underlying this transformation, and that is the increasing share of global economic activity that's coming from the emerging market economies, particularly those in Asia. So to illustrate this global shift that's underway, in the 1950s, around 15% of the world's economic output was located within 10,000 kilometres of Australia. Today, that share has risen to around a third, and it's likely to continue to reach about a half of world output by 2050. Now, much of this shift is clearly attributable to the growth in China and India, and combined, these economies now constitute around about 1/5 of the global economy, as you can see from this chart, whereas only a decade ago, 20 years ago, they accounted for about only 10% of global economic weight. Importantly, if you look at EMEs in total, emerging market economies in total, for the first time they've hit half of global GDP. And I'm going to come back and talk about this. Now, the growth paths of emerging economies are inherently more volatile than those of developed economies, because they're trying to manage this transition from being poor, often centrally planned, to things where individual preferences and the market play a much bigger role. And how they manage that transition is always really quite difficult. So you don't just have the potential for economic shocks, you have the potential for policy mistakes, and those policy mistakes or policy mistake risks are heightened in those sorts of environments. But as I said, that they now comprise in total around half of global GDP. But more than that, over the next 5 years, they're expected to comprise around about 3/4 of global GDP growth. So you go back to the 1990s, as you can see from here, EMEs were about 35% of global GDP, but they contributed around 40% of global growth. Through the 2000s, they've contributed around 65% of global growth, and over the next 5 years, we anticipate around about 3/4. So the share of the global economy that is taken up by these emerging market economies is just going to continue to grow over time. And our Asian neighbours, China and India in particular, but it's not a China and India story alone, it's also Indonesia. Indonesia is now a bigger economy in purchasing power parity terms than Australia. It has been since 2006. You ask any Australian, they almost always think Indonesia is much smaller. It's not just Indonesia though, it's Vietnam. You're seeing it in Malaysia and others. So what we're really seeing is that in a whole variety of countries that traditionally we've thought of as being less developed are now in quite rapid growth paths. And so as they grow, they become more important globally. And they also, therefore, become more important in both a geopolitical and a geostrategic sense. Now, that's one side of the story. The other side of the story is that the sluggish growth, the high unemployment and the fiscal sustainability pressures being experienced in many developed economies, particularly those on either sides of the North Atlantic, is only adding to the extent and speed of this shift from west to east. While short-term financial pressures in Europe have been relieved for the time being by the European Central Bank's recent policy announcement on conditional sovereign debt purchases, ultimately this is not enough to resolve the underlying causes of the European crisis. A more lasting resolution to that crisis would require Euro area governments implementing the sorts of reforms that can achieve a closer banking, fiscal and political union. They also need structural reforms to improve competitiveness and drive long-term growth. And I'll explain in a moment this chart. In the decade leading up to the crisis, the competitiveness of many European economies deteriorated quite dramatically relative to Germany. So cast your mind back to the Euro experiment. What was going to happen? The Germans were going to get access to a common currency, which, because it would have weak economies in it than Germany, would mean the exchange rate would be lower than if they kept the Deutschmark. In exchange for that, the periphery would get access to German interest rates. They would therefore be able to borrow. The grand plan was that they would invest dramatically to improve their productivity and they'd leap forward. Now, how do we think about international competitiveness? We think in terms of the real exchange rate. The real exchange rate is the exchange rate between the nominal exchange rate, which we hear reported on the TV every night, between countries. Well, that's one in Europe because the Euro area countries are all using the same exchange rate. And the real exchange rate is then deflated by the differences in price levels across countries. So if the experiment had worked, if you set everybody's price level at this, just index it to 100 back at the beginning of the Euro area, if the experiment had worked, what we would have seen is that prices in all of these other countries over a long period of time would have fallen below Germany's. And this chart shows you exactly what's happened. In fact, rather than falling below Germany, so rather than growing more slowly than German prices and gaining competitiveness, they have all lost competitiveness because their price levels have grown dramatically vis-a-vis that of Germany. This not only helped fuel the crisis, but this lack of competitiveness is impeding their ability to recover. To address these competitiveness issues, they have to embark on a period of broad-ranging reforms to labour and other markets, so of the sort that we pursued in the 80s. And as we all remember, the payoff from these things do not occur quickly. So unfortunately, our European cousins are probably looking at a decade of very painful experience while they dig themselves out of the environment they've gotten into. At the same time, as they've got to do these structural reforms, their debt positions are such that they've got to undertake very serious fiscal consolidation. Now, a key risk, if you're thinking about a decade-long story to tell your public, we're going to have to engage in fiscal austerity for a decade. We're going to have to, spend a decade doing these really hard, contentious structural reforms. You have to ask the question of how long you can bank on societal acceptance. And in the absence of shorter-term measures that will actually help boost growth, I think we're at risk of seeing very significant potential volatility emerge from our European partners over the decade ahead. But it's not just Europe. The real elephant in the room when we talk about the global outlook is the risk that the US could fall off the fiscal cliff. And what I mean by the fiscal cliff, you recall that last year the US Congress established this super committee. It agreed that there would be mandatory outlays reductions commencing at the end of this year unless Congress agreed on a sensible path forward that would lead them to fiscal consolidation. So in other words, what they did is they set up a hurdle that said we're going to be really tough on ourselves in the hope that they'd never have to be, because that would be enough to get Congress to take decisions that ease them into fiscal consolidation. And at the same time, the Bush-era tax cuts, which have already been extended, were due to end. Now, the difficulty is that if the scheduled tax increases, or the ending of the Bush-era tax cuts, and the outlays reductions imposed by the super committee come to pass, which will be basically this month and next, we will see a very significant impact on US growth. Indeed, the Congressional Budget Office suggests that growth in the US may be minus 3% in the first half of next year. And over the course of next year, maybe minus 0.3 for the year as a whole. We keep waiting for the political process to intervene. I have to say, personally, I expected it to be kicked past the election. May still be, but the amount of time is running out. So what the CBO, the Congressional Budget Office, has suggested is that the US, without any action, is looking at a slowdown of the magnitude last seen in the early 1990s. This chart, though, shows you a plausible scenario, which the CBO has also done, which is to suggest that nothing happens. That is, there's no fiscal consolidation. And that gives you not the Blue Mountain Range, but the Blue Mountain Range with the red on top. The scary thing about that is that saying that failure to embark on measured fiscal consolidation risks US government debt levels rising to the sorts of levels seen in Europe today. So the United States has got quite a challenge. But what this means, I said earlier, the emerging market economy is now half of global GDP. Inherently, they are more volatile in their growth paths, so they have bigger swings and roundabouts. And the traditional parts which provide stability to the global economy, the North Atlantic, as we can see, are themselves likely to be sources of volatility. The message out of this is that countries need to be prepared for a period of volatility in the global economy of a sort that we probably haven't seen on a sustained basis since the 1970s. So what's all this mean for Australia? Well, the consequences of the growth of the emerging economies can be characterised as coming in three waves for us. And you guys are living smack bang in the middle of one of these waves. The first wave, and the one that you're experiencing most personally, is the rapid expansion of the mining sector. The second is the growing demand for our agricultural produce and the desire to invest in Australian agricultural land and food producers. And the third's the rise in the middle class in the Asia-Pacific region. I'm going to touch on each of these briefly. I'll spend a little bit more time talking about the first, though, because there's been a lot of misinformation around the end of the mining boom. It is neither an end nor is it a boom, and I want to talk a little bit about that. So this first wave, the rise of the mining sector, can itself be thought of as having three components. The initial stage is the rise in prices for our products when we haven't done anything. We've not invested, we're just sitting there digging the stuff out of the ground, selling it overseas, and all of a sudden prices go through the roof. What's happened is that the world has decided to shower us with money. Fantastic. Unfortunately, that started in the early 2000s and peaked last year. So the world's no longer deciding to shower us with money for not doing anything. The second part of this is that we then respond to this shower of money, and we start to invest dramatically in expanding the capacity of the mining sector. And this is the huge investment boom that we've had. We've gone from a situation where mining investment's been around 1 to 2% of GDP. This year it could be well over 8% of GDP, and I'll show you a chart on that in a moment. And then the third part of this mining story is the one that we're only just beginning to see now. So the mining investment component is close to peaking out. That is, we expect it to have hit its maximum contribution to growth probably in 2013. It'll stay high for some time and then gradually taper away. But that is really only just setting us up for the permanent component, which is the strong rise in extraction and hence in export volumes. So the term resources boom is simplistic because a corollary of a boom is a bust, and we are not about to face a bust. What we are seeing is a set of terms of trade, which is the price of our exports over the price of our imports, that have moved to historically high levels. And yes, they will come off. They are already coming off. We've anticipated they're going to come off. Can we predict exactly how much they'll come off in each year? We'll do our best, but you know it's a bit of a lottery. But the one thing that we can be absolutely sure of is that they're going to remain high for a very long period of time, and the investment that they have induced are going to mean that the mining sector is going to be a dramatically larger part of the Australian economy at the end of this than it was at the beginning. And you can see this from here. So, you know, go back to 1990, the mining sector as a whole has basically bounced around about 5% of GDP. And we're in the midst of this transition that sees mining sector as a whole move from about 5% of GDP to something like 10 to 12% of GDP. So it is not a boom, it's a radical reshaping of the economy. We end this period of adjustment, which is going to take quite a period of time. We end this period with a mining sector that is a dramatically larger share of the Australian economy. Along with Glenn Stevens, I strongly believe that rumours of the death of the mining sector have been greatly exaggerated, and the analogy with the boom and bust cycles that we've had in the past is just completely misplaced. That boom, as I said, wasn't a boom, it was a terms of trade shock. Now, think about this in really simple terms. China emerges from isolation. What does it do? It needs a whole pile of minerals and energy in order to drive its economy. So it pushes out the global demand curve for minerals and energy, but it doesn't do much to the global supply curve. That is, it doesn't have a lot of its own. At the same time, this urbanisation, industrialisation that's driving China, and which is increasingly driving India and the other countries in our region, means that there's a huge influx of labour into the manufacturing sector. So it drives out the global supply curve for manufactured goods and doesn't do much to the global demand for manufactured goods because China, India and others are still quite poor. Consequence of that, you drive up the price of minerals and energy, you drive down the price of manufactured goods. Australia is an exporter of minerals and energy and an importer of manufactured goods. We get this double whammy. It means that our terms of trade, price of our exports over the price of our imports, takes off. And you can see this here. We've had two periods prior to this where our terms of trade have reached very high levels. The most recent was the Korean War boom, and that was all wool because the Korean War was a wool war. In other words, you couldn't fight in Korea unless you had decent equipment, and that decent equipment required a lot of wool to keep you warm. But it occurred quickly and it ended quickly. In contrast, we've been going now for well over a decade of seeing rising terms of trade, and we see the terms of trade, even though they come off, as remaining at historically high levels for the next 15 plus years. Now, what this has done is converted into a huge positive income shock for us. By that I mean that real GDP per capita, the number of widgets per person that we produce, has continued to grow, but the price we've been getting for the widgets has gone through the roof. So our real gross national income per head has risen dramatically faster than our real gross domestic production per head. Now, the flip side of all this, though, is that higher minerals prices have also exerted pressure on our non-mining sectors by pulling resources towards the mining sector. And as Glenn Stevens said, in 2005, a shipload of iron ore bought you 2,200 plasma screen TVs. Today it buys you 22,000 plasma screen TVs. That's the magnitude of the increase in the purchasing power that Australians have had. At the same time, the high exchange rate that goes along with this rise in the terms of trade is leading to real challenges for other trade-exposed or labour-intensive sectors such as manufacturing and tourism. So that was the first stage of the mining story. The second, the rise in investment driven by higher prices. As I said, we expect to see that mining investment heads up to around 8% and possibly 8% plus of GDP. And while it will sort of peak out around there, we expect it to sort of stay close to those levels for a couple of years and then gradually ease back. And then, as I said, beyond that, we will see the increased pickup in extraction and hence in exports. Now, in terms of exports, we're not only exporting more of the stuff we dig out of the ground, but we're also exporting more of our expertise in this space. So you can see the rapid growth in mining services expertise going out into various parts of the world, particularly in Africa. Excuse me. So to label this as a mining boom, I think completely misunderstands what's happening. The second wave, though, of impacts on us is occurring in the agricultural sector, and that's leading to a rise in global demand for agricultural products, significant increase for demand for high-end products like fruit, dairy, good quality meat and seafood. Again, like the mining sector, we're well placed to benefit from that as long as we can handle the foreign investment dimensions and the obvious concerns in some parts of our communities. And we have to basically have a pretty frank discussion about that. The third wave, though, so those first two waves were preordained to benefit. The third wave we're not. And the third wave is the rise of the global middle class. Currently, excluding North America, there are around 500 million middle-class consumers in the Asia-Pacific, and they're at the bottom end of the income band that we think of as middle class. By the time we get to 2020, we anticipate that'll be something like 1.7 billion. So 500 million now, 1.7 billion by the end of the decade. By the time you get to 2030, about 3.2 billion. So by the 2020s, China has become a bigger market for middle-class products than the US. By 2030, the Asia-Pacific region is probably 2/3 of the world's middle-class consumers. We're sitting on the doorstep of that. We have massive opportunities available to us, but we are not preordained to win from that. The challenge for us is to work out how to grasp those opportunities. So I want to talk a little bit about those now. There are really three significant challenges and opportunities for us in the coming decades. The first is going to be to protect our endowment of sound macroeconomic policy frameworks. This sounds dull, dry, boring, only the sort of thing that an economist would get excited by, but it's actually really important. In a number of fora over the last year, I've championed the central role that these frameworks that we've introduced in this country over the last 25, 30 years have played in the relative stability of Australia's economic performance. Remember, we have grown non-stop for 21 years. There is no other advanced economy in the world that goes anywhere close to matching our performance. And why? Why have we grown despite facing three of the largest, if not the largest, shocks since World War II? It's really these frameworks. And when I say frameworks, what am I talking about? First is medium-term approach to fiscal and monetary policy. Second is the emphasis on a market-determined exchange rate. And the third is our reliance on price signals to move people and resources to where they're most productive and valued. Together, they've given us the flexibility to deal with the sorts of shocks that have come our way. Now, when problems arise, there's always the temptation to chip away at the fundamental components of these frameworks, to say we should intervene in the exchange rate or we should attempt to restrict foreign investment, whatever. Every time we do that, we have to understand what it is we're giving up. So just take the exchange rate. Arguing that we should intervene to attempt to lower the exchange rate forgets Australia's history up to 1984, when we constantly tried to control the exchange rate, and it was an unmitigated disaster. So every time people talk about these sorts of things, they sound great, they sound glib, if only. Well, the thing is, the if only bit is the bit that's a problem, because we can't actually intervene to change these things in a sustained fashion without causing other problems. Think about it this way, right? We're in a world where in a situation where the world wants to give us more money for the goods and services we produce. The exchange rate, in real terms, has to appreciate. The nominal exchange rate, as I said, the thing you see on the TV every night, can either go up or inflation can go up. And we know that if inflation goes up, that causes a dramatically different set of impacts on the economy, and it particularly hurts the poor compared to a situation where the nominal exchange rate is allowed to move and people are able to see more clearly the price signals and move resources in response. And you can see this here, right? Look at what happened when we've had previous, and we're calling them booms because some of these early ones were booms. The 1950s and the 1970s, terms of trade go up a little bit. In the 50s, they go up quite sharply, but don't stay there for that long. Inflation goes up and stays up for quite some time. Ditto the 70s, took a heck of a long time to squeeze it out. But look at the first part of the mining boom up to the GFC, and the second part since the end of 2009, we have not seen inflation performance in this country. And that is incredibly important. So we should always aim to improve and adapt our frameworks, but in doing so, we should not lose sight of the importance of openness and flexibility, and particularly given the growth of demand in the region requires us to be a trading nation, we need to be conscious of the importance of openness to trade and investment. We need to make sure our scarce resources are able to move quickly so we can take advantage of the opportunities. So workers, investors and entrepreneurs have to be able to direct their resources according to their best judgments in response to appropriate price signals. And that leads me personally to a presumption in favour of deregulation wherever feasible. I'm going to come back and talk in a moment about bipartisan fiscal policy, because that's a really important element of the framework. But the second challenge I just want to touch on quickly, and I know I'm running out of time, John, so and that is that future growth in living standards has to be driven by productivity. If you if you look at this, it's showing you the contribution to growth in average incomes coming in the blue part of the bar from labour productivity, and the red part from the terms of trade. You can, for the wonks, they can work out what the grey bits mean, but for everyone else, just focus on the black line. The really important message is that over the 2000s, almost half of the rise in our living standard has come from a rise in terms of trade. That only occurs while the terms of trade are continuing to rise. I said before that the terms of trade have flattened and now falling. That means that the red bar in future will sit below the zero line, which means that the black line, which will be the net of the red and the blue bars, will be determined by how far above the line the blue bar is, combined with how far below the zero line is the black. That's why productivity is important. That's why we've got to basically focus on improving the environment for productivity through focusing on enablers such as education, skills and infrastructure, and through combined efforts of all levels of government to remove unnecessary regulation. And the third issue I just want to touch on quickly is what do we need to do to build comparative advantage to take up those opportunities provided by the growth of this global middle class. As said earlier, there's no reason why we are preordained to benefit from the rise of the middle class. We talk about proximity to Asia, but Beijing is closer to Berlin than Brisbane is. Yes, we have proximity in the sense, particularly in terms of time zone, we have proximity in the sense that we have complementarity with those countries in the region, but we do have to think very carefully about what sort of investment and cooperation do we need from the public and private sector, not only in policy frameworks, but also in human capital, physical and socio-economic infrastructure that will allow us to reap those benefits. There's Treasury, the Reserve Bank and the IMF hosted a conference last month on structural change and the rise of Asia. And it was really interesting that the presenters at the conference continually hammered away at the point that Australian businesses need to engage in a more richer fashion with Asia. That is, they need to stop just thinking about this as a place where we can sell stuff and create brand name and recognition. The Asian Century White Paper, which is due out shortly, is really aimed at creating a conversation in Australia. It is not a roadmap for governments to pursue over time to basically make sure we grasp those opportunities. It is really a device for the Australian community to begin to have a conversation about what we will need to do over time in order to grasp these opportunities. At that conference, though, I was also struck by comments that were made by Professor He Fan and Masahiko. He Fan is from the Chinese Academy of Social Science, and Masahiko Takeda of the IMF. And it was really interesting, both commented as outsiders that there was a strange disconnect between Australia's economy and Australia's perceptions of it. So it's striking to outsiders how angst-ridden we are about this. And indeed, I share that view, that there's considerable persistent and, in my view, unwarranted pessimism about the outlook. Yes, we have some challenges, but we've always had challenges. What we've got is a fantastic framework to build from if we're prepared to do it. As I said, we've got 21 years of uninterrupted economic growth. Unlike almost any other advanced economy, we have virtually, sorry, I'll come back to that one in a minute, virtually minimal debt by international standards. We have a AAA credit rating. We're one of 7 countries in the world that have a AAA credit rating from all 3 ratings agencies. In terms of the experience, in terms of household wealth, over the period since the GFC, we stand out. Our median household wealth has continued to rise, whereas in contrast in the United States, in real terms, it's fallen by a third since the GFC. Our personal disposable income has risen by 24% in Australia since December 2006. In contrast, the United States and the UK are 4.8% and 2.1% above those levels. Our performance has been something to be celebrated, not criticised. Across the OECD, these are the sorts of debt levels that you see today and expected out over the next 5 years. And they stand in sharp contrast to Australia's performance. Now, don't get me wrong, we're subject to global volatility. We have to be prepared to handle that. But what I'm really saying is that our underlying fundamentals are strong and the opportunity set in front of us is something to be celebrated, not criticised. One area that does require attention, though, is the fiscal sustainability of government. And by that I mean both Commonwealth and states. I mentioned the bipartisan commitment to medium-term fiscal policy or fiscal strategy before. That's what's delivered this sort of low debt levels going into the GFC, giving us the massive capacity we had to respond to the crisis, and it's also the thing that is driving us towards delivering surpluses and paying down debt, because it's important for prepping us as we go forward. But the problem, or not problem, the challenge is that as a community, we need to make some choices about what government can and should provide and how these should be funded. Now, I want to be really clear. I am not in any way saying anything about what should be our priorities. What I'm saying is that whatever our priorities are, we have to have a considered and national debate about what they should be, what the role of government in providing those is, and then how we go about funding them. Why? Well, there are a number of pressures on our fiscal position that we need to be conscious of. The first is the ageing of our population will mean slower rates of growth, slower rates of economic growth, because the participation rate will fall. So we have this sort of situation that participation rates of older people are rising, but the level of participation of older people is much lower than of younger people. So as they become a bigger share of the population, because of the demographic issue I talked about before, it will drive down the aggregate participation rate in the economy. And given that GDP growth is a function of population, participation and productivity, population isn't going to change dramatically from what we can see. Participation will be a challenge and productivity will be a challenge. Second, we're getting richer, and that means our expectations for goods and services have improved, particularly those, I shouldn't say improved, have increased, particularly on those things delivered by government. We know that over the next decade or so, we're going to be facing significant spending pressures in the areas of health and aged care as the population ages and the average cost of services increase. Together, that's going to mean that these sorts of spending areas will become an increasing share of GDP. Healthcare costs at Commonwealth level are expected to grow fivefold over the decades ahead. A significant portion of this will be driven by ageing population, but also be driven by the fact that we're demanding higher quality healthcare. And as I put it, doesn't always go down that well, but as I put it, our generation is not going to accept the quality of healthcare and aged care that our parents were prepared to accept. And if we're not prepared to accept it, we've got to work out how we're going to pay for it. Compounding these pressures are community expectations that government will provide new services, national disability insurance schemes, an example here, or deliver substantial reforms to existing services that could entail more spending, e.g. school funding proposals that are on the table. Again, I'm not making a comment about these in any way. I'm simply saying every time the community raises expectations of what governments will deliver, we have to think about how we fund them. And then the third is there are very significant changes underway between, in terms of relationship between revenue collections and GDP. This just shows on the left-hand side that nominal GDP has grown broadly the way it was estimated in the 2008-9 budget. So 12-13 is basically history. And it shows you that history hasn't deviated a lot from what was anticipated in 08-09. But look at the chart on the far side, and that's tax receipts. And tax receipts have been dramatically lower relative to what we'd expected. A couple of reasons for that. I've talked about this previously. With hindsight, it appears that some of the revenue collections of the early 2000s were a bubble. And so giving that revenue back to the public through tax cuts has created some weakness in the tax base, but it's been exacerbated by the fact that the balance of growth in the economy is leading to different revenue outcome. What I mean by that, compared to a situation where the economy as a whole, all parts were growing equally, we've got a situation where the mining sector is growing very rapidly. The mining sector is engaged in investment boom. When you're engaged in investment boom, you have massive depreciation deductions and upfront deductions, and that means that the revenue collection per unit of GDP will be lower. Nothing wrong with that. This is not a judgment. It's simply a statement of fact. But it raises the important issue that the more we think about this about the pressures for new spending areas and like that, we need to have this debate about the size and scope of government, both at each level of government and between the levels of government. That is, what role is appropriate for the different levels. And I see that debate being shaped by a series of questions. The first is what we as a just and democratic society want or expect our governments to provide. The incomes of Australians will continue to grow, albeit at a slower rate, and we will increasingly demand better goods and services. Now, at times, the debate presumes that government will provide those goods and services. I think we need to have a discussion about whether that's a presumption we can afford. There are many worthy and constructive programs that governments could potentially fund, and there are so many that they exceed the capacity to fund them. So we need to think about what government should provide and fund as against what individuals should do. When we've worked out what it is that we think government should fund, then we need to ask ourselves what's the best way to fund them. And while mention of this always creates excitement, I'm going to do it anyway, because it's a truism. Any increase in spending has to be offset by either an increase in revenue collections, an increase in user charging, or a reduction in outlays elsewhere. Now, who wants to take a bet that tomorrow or the weekend there will now be some aside that Treasury is wanting higher taxes? I didn't say that. Let's be explicit, right? This is a truism. You cannot get it to add up unless one of those other things moves. So this is a really important issue for Commonwealth and the states. This isn't a Commonwealth story. It's not a state story. It affects all of us together. We cannot think, though, about the government provision of services in isolation from government revenue. The two are intrinsically linked. And so if we're going to think about what we want government to do, then the community also has to think about what tax system it wants and how it's going to pay for things. And it has to think about how it pays for what it wants, while at the same time ensuring we've got the right incentives for investment, physical and human capital, innovation and participation. Now, I'm sorry, I know I'm well over time, but I'll quickly try and make a couple of points and then wrap up. So, given recent pressures on tax collections and following the Henry Review, the Commonwealth has set about doing some repair work to broaden and strengthen the integrity of the personal and business tax bases. Just to give you a few examples, the phasing out dependent spouse tax offset no longer reflects the reality of women in the workforce. Reforms of tax concession for living away from home allowance no longer reflects the difficulty we had in the past in getting people to move, limiting the tax concession for, executive salary packages through better targeting the employment termination payment offset. If you look at any of these in isolation, you wouldn't say they're a big bang, but if you look at them in total, they're just the sorts of efforts that we need to repair and maintain the tax base. More broadly, work undertaken by the OECD and highlighted in the Henry Review points to the significant benefits for sustained growth in moving the tax mix away from income taxes and towards potentially less mobile and therefore less distorting bases. In general, small and open economies should configure their tax systems to encourage both investment and participation. In the longer term, reliance on mobile bases for a high proportion of revenue may see increased risks of tax base erosion and stronger disincentives for capital investment and for people to acquire productivity enhancing skills. Flip side though, as you move towards those sorts of tax bases, it has implications for equity. Raising taxes on some immobile bases, particularly consumption, may have implications for perceptions of the fairness of the tax system, its social acceptability, and hence, in the long run, the ability of governments to actually collect that revenue. Now, for many people, tax reforms come to mean personal tax cuts. You can't talk about either making any individual tax more or less progressive or raising tax rates at all. But in actual fact, it's not the progressivity of any individual tax that matters, it's the progressivity of the system as a whole, because you engage with the system in its entirety. Sustainability, though, is also not just a Commonwealth issue, it's a state issue. I mentioned some of the things that the Commonwealth has been doing as repair and maintenance, and I just want to point to a particular issue that keeps being raised, and that is that while states are taking steps to address their own fiscal pressures through increasing taxes and cutting outlays, some of the debate calls for an increase in the rate of GST in order to fund state tax reform. It's worth making 2 points about this. Both major parties at the Commonwealth level have ruled out a GST increase. With no other Commonwealth revenue flows available, fiscal transfers between the states simply shift the fiscal sustainability issue from one state to the other. So the HFE debate, horizontal fiscal equalisation debate, what's West Australia's share of the GST revenue? To the extent that West Australia wins, some other state is going to lose out. So that's just shuffling the fiscal sustainability challenge. And if the Commonwealth has no additional revenues, claiming that Commonwealth should put more money in simply shuffles it vertically rather than horizontally. Don't know how the review of GST distribution will come out. They're due to report later in the year, but understanding that this will only shuffle the challenge is important. The second, the GST is only part of state revenues, and it is a relatively efficient tax, but states have a very efficient tax at their fingertips too. What is it? Well, there's two. There's land and payroll taxes, and they're real opportunities for reform. Payroll tax is about a third of state revenues. The states have harmonised their tax bases, but they have eroded payroll tax revenues through exemptions. Now, why have they given exemptions? Well, it's because it's clear that payroll tax is a tax on jobs. Only problem, it's not. This conclusion is a consequence of confusing legal incidence and effective incidence of the tax. Yes, businesses remit payroll tax to the state revenue offices. The burden of the tax, though, is passed forward to forward to consumers today on workers and also on the owners of capital. And funnily enough, that's exactly what the GST does. A comprehensive payroll tax is the same as a GST. So every time somebody says we should increase the rate of the GST, my immediate reaction is come back and talk to me after you've fixed up your payroll tax base, because you actually have the capacity to run your own GST through the payroll tax system. That's undoubtedly going to get me some coverage. So, main message I want to leave you with, apologising for having gone too long. We live in uncertain times. There's global volatility and structural change that are going to endure for the foreseeable future. But the really important thing as a country, we have very sound fundamentals and we have an amazing set of opportunities in front of us. If we're to grasp those opportunities, we do need to talk about productivity, but we also need to talk about fiscal sustainability, and we need to have a more mature debate about those things. And thank you very much.